Fintech has introduced a wave of innovation to the financial sector. Today, customers can handle everything from daily banking to complex investing right from their smartphones, a stark contrast to the days of in-person branch visits. But it doesn't stop there. Fintech is democratizing financial services, making tools once reserved for the wealthy accessible to everyone. Robo-advisors, for example, offer affordable, algorithm-driven financial advice tailored to individual goals and risk appetites. These platforms provide services at a fraction of the cost of traditional advisors. Let's have a look on those sectors that Fintech has transformed. Sector number 1. Payment revolution. Payments are another area transformed by Fintech. Digital wallets and peer-to-peer apps have become the preferred methods for transferring money and making purchases, especially among younger generations. Sector number 2. Lending reinvented. Lending has also evolved. While traditional banks rely on conservative metrics, Fintech companies leverage advanced data analytics to assess creditworthiness. Machine learning models analyze non-traditional data, like utility payments and online purchase histories, to create a more accurate financial profile, expanding credit access to those who might be overlooked by traditional systems. Sector number 3. Challenges for traditional banks. To stay relevant, many are partnering with Fintech startups or investing in new technologies. These collaborations blend Fintech's agility with banks' regulatory expertise and established customer bases. However, with opportunity comes risk, particularly in cybersecurity and data privacy. As services move online, banks and Fintech firms must prioritize protecting sensitive customer information. Now take a deep dive in banking and Fintech works. Section 1. Neobanks and challenger banks. These digital-first banking models focus on providing seamless, user-friendly experiences, challenging the dominance of conventional banks with physical branches and legacy systems. Neobanks operate entirely online, offering banking services exclusively through mobile apps and websites. By eliminating the costs associated with physical branches, neobanks provide higher interest rates, lower fees, and enhanced accessibility. Their operations revolve around simplicity and convenience, catering primarily to tech-savvy users who value efficiency. Key features such as real-time spending alerts, automated budgeting tools, and customizable savings options enhance financial management for customers. Challenger banks, while similar to neobanks, may maintain some physical presence and often emerge as modernized extensions of traditional financial institutions. They blend technology and innovative business models to compete directly with established banks, emphasizing user-friendly interfaces and tailored products. Both neobanks and challenger banks utilize advanced data analytics to offer personalized financial insights. By analyzing spending habits and behaviors, they provide tailored advice such as highlighting savings opportunities or improving credit scores. Security is another area where these banks excel, incorporating encryption, biometric authentication, and app-controlled card management to ensure robust protection against cyber threats. Despite their appeal, these banks face challenges, including building consumer trust and navigating complex regulatory requirements. Many customers remain loyal to the familiarity of traditional banks, and compliance demands significant investment. Profitability is another hurdle, as fee-free services and attractive interest rates often necessitate a large customer base to sustain revenue. Looking ahead, the future of neobanks and challenger banks is promising. As digital banking gains acceptance and these entities refine their models, potentially integrating artificial intelligence and blockchain, they are set to expand their influence. Section 2. The role of physical bank branches. With digital banking on the rise, what's the future of physical branches? While some might predict their disappearance, the reality is more nuanced. Instead of becoming obsolete, branches are evolving into hubs for complex financial services. Modern branches focus on personalized experiences, offering services like wealth management and business consultancy. They are being redesigned to feel more like lounges or co-working spaces, fostering relaxed and productive discussions about financial planning. Technology also enhances in-branch experiences. Interactive kiosks and augmented reality tools allow customers to explore financial products hands-on before consulting advisors. Despite high operational costs and declining foot traffic, branches remain essential for customers seeking face-to-face interactions, particularly for major decisions like mortgages or retirement planning. Section 3. Personalization in banking through technology. Leveraging technology, banks are reshaping traditional services into personalized experiences, enhancing customer satisfaction and loyalty. At the core of personalization lies data. Customer transactions and interactions generate vast data, offering insights into behavior, preferences, and needs. By analyzing this information, banks can design highly tailored financial products and services, such as customized savings plans, loan offers, and investment strategies. Advanced technologies like artificial intelligence, AI, and machine learning play a pivotal role in this evolution. For example, machine learning algorithms can predict a customer's need for specific financial products, such as mortgages or retirement plans, based on their life stage and past behavior. Predictive analytics enhance this experience by providing tailored alerts, such as reminders for recurring bills or savings suggestions. Despite its benefits, personalization poses challenges. Privacy concerns demand transparency and robust data protection measures. Banks must also ensure inclusivity, bridging the digital divide for less tech-savvy customers through education and support. This trend promises to redefine customer experiences, setting new benchmarks for innovation in the banking industry. Section 4. Case studies of successful fintech bank collaborations. Collaborations between traditional banks and fintech startups have significantly reshaped the financial services landscape, driving innovation, expanding market reach, and enhancing customer experiences. These partnerships demonstrate how the strengths of both sectors can be combined to set new standards in banking. One prominent example is the partnership between J.P. Morgan Chase and OnDeck Capital, aimed at revolutionizing the small business loan process. OnDeck, known for its advanced data aggregation and credit scoring technology, helped J.P. Morgan streamline loan approvals. Previously, securing a small business loan from a traditional bank was a time-consuming process, often taking weeks. This collaboration reduced approval times to minutes and enabled funding within days. By accelerating the loan process, J.P. Morgan improved customer satisfaction, reached a broader customer base, and reduced the operational costs associated with loan processing. Another notable success story is BBVA's acquisition of Holvi, a Helsinki-based online banking service catering to entrepreneurs and freelancers. Holvi offers tools for invoicing, financial planning, and cash flow management, integrated into a digital banking platform. By acquiring Holvi, BBVA expanded its digital services portfolio and tailored offerings to a niche market that traditional banks often neglect. Combining BBVA's financial expertise with Holvi's innovative features created a unique value proposition for small businesses and freelancers, strengthening BBVA's presence in the fintech sector. The strategic partnership between Goldman Sachs and Apple to launch the Apple Card highlights another successful collaboration. Designed to operate within the Apple ecosystem, the card offers seamless integration with Apple Pay, no fees, daily cashback rewards, and advanced security features. For Goldman Sachs, the partnership provided a foothold in the competitive consumer finance market, while Apple enhanced its wallet app's functionality and customer retention. This collaboration combined Goldman Sachs's expertise in credit management with Apple's vast user base and brand loyalty, resulting in a tech-driven, consumer-friendly product. These examples underscore the mutual benefits of fintech bank collaborations. Banks gain access to innovative technologies and modernize their services, while fintech startups scale their operations and build credibility. Such partnerships also drive industry-wide innovation, enabling both parties to meet evolving customer expectations for personalized, efficient, and secure financial services. Section 5. Regulatory implications for banks and fintechs. The rapid growth of the financial technology, fintech sector, has revolutionized financial services, offering enhanced efficiency, accessibility, and innovative products. For banks, the rise of fintechs has underscored the need to innovate while maintaining compliance with stringent regulations. Banks operate in highly regulated environments, with requirements addressing customer data protection, cybersecurity, anti-money laundering, AML compliance, and capital adequacy. Adopting new fintech-driven technologies often necessitates costly changes to their operational and risk management structures, slowing the pace of innovation. However, these measures are critical to aligning with regulatory standards and preserving consumer trust. In contrast, fintech startups often begin as tech-driven entities and approach financial services with a focus on innovation. Fintechs must navigate requirements for consumer protection, AML compliance, and cybersecurity. The diversity of their offerings, ranging from payment processing and peer-to-peer lending to cryptocurrency trading, further complicates compliance, as each service often falls under different regulatory frameworks. Operating across international borders adds another layer of complexity. Regulatory environments vary widely, and fintechs must adapt to jurisdiction-specific laws like the European Union's General Data Protection Regulation, GDPR, which sets stringent standards for data privacy and security. Compliance demands robust systems to safeguard personal data and obtain customer consent, which can be resource-intensive. Emerging technologies such as blockchain and artificial intelligence, AI, present unique regulatory challenges. Blockchain's decentralized nature disrupts traditional jurisdictional control, while AI introduces concerns about transparency and algorithmic bias. Regulators are still developing frameworks to address these issues, striving to balance innovation with risk mitigation. To foster innovation while maintaining oversight, some regulatory bodies have introduced regulatory sandboxes. These allow fintech startups to test products in controlled environments without immediate compliance burdens, promoting innovation and enabling regulators to better understand emerging technologies. Collaboration between regulators, banks, and fintechs is vital. Open dialogue can clarify expectations, enabling fintechs to design compliant products from inception. For banks and fintechs alike, regulatory navigation is about more than compliance. It is a strategic opportunity to build consumer trust, gain a competitive edge, and drive sustainable growth in the evolving financial ecosystem.